We came along and said, we have something that is simpler, cheaper, and puts up better numbers. And they hated it. It's not their money. When somebody comes in and says, I can do it more cheaply and efficiently, honestly, they don't want to hear that.
In 1994, a young analyst joined one of the most secretive and well-respected hedge funds on Wall Street, Seth Klarman's Baupost Group. He was one of just 6 generalist portfolio managers. And Klarman taught him a single idea that shaped his career. Risk is a function of downside, not volatility. 20 years later, Andrew had a heretical realization. Most of what hedge funds were charging 2 and 24 were not achieving alpha. It was beta, exposures that you could replicate cheaply in an ETF with daily liquidity. So he built a firm to prove it. Today, Dynamic Beta Investments runs $2.2 billion and manages the largest managed futures ETF in the world. Andrew doesn't sell private real estate. He sells the discipline of asking what you're really paying for. Last episode, Phil Shankweiler made the case for institutional private markets. Today, we test it. When you pull back the wrapper on every allocation for alternatives in the modern portfolio, and what does that mean for asset classes that can't be genuinely replicated? I'm Samantha Parinello, and this is Wealth Unfiltered. And help me please welcome to the show, Andrew Beer. Hi there, Andrew. How are you?
I'm great, thank you. How are you?
I'm doing fantastic. Thank you so much for joining us today. You know, as I had mentioned to you earlier, we have a really wonderful series where we are helping the modern allocator and really trying to give as much resources as we can. So what I would love is if you could give a little bit of background on yourself to really explain to them why I thought it'd be very valuable for you to be here.
Well, thank you. First of all, thank you so much for having me. I mean, helping the modern allocator, that's what I spent the past 10 years thinking about. Particularly as it relates to the RIA space and the whole wealth management world. My background is very different, though. I started in the hedge fund industry over 30 years ago, and that's a very different world. I went into the business when it was in its early stages. I worked for some great people. I went off and started my own businesses in very different areas, one in the commodity space, another one actually had a team of people focused on the greater China region. I've been an entrepreneur over the past 30-something years, but my focus really over the past 15 years has been, you've got all of these people who are managing assets for hundreds or thousands of clients, and they're all trying to figure out, how do I make those portfolios better? What can I bring to the portfolio? And again, to take a step back, we like to talk in statistical terms, but it's really, how do I help people to grow their assets and sleep at night? How do I help them meet their long-term investment objectives? And in the world that I came from, there are some things that are very, very, very valuable for that, but have historically been out of the reach of the average investor. So really what my partner and I have done over the past 10 or 15 years is basically say, what would be really valuable for the modern allocator? The person who's thinking, stocks and bonds worked really well, but now we need more. We need something. We need better arrows in our quiver. And so we've built a business that today, our business is called DBI. It's about a $7 billion asset management business. Our whole focus has been, how do we help you solve the problem of bringing diversification into a portfolio, and so that you're happy and your clients are happy?
That's incredible. Earlier, when I did my recording, I said 2.2 billion, but it's clear my numbers were off. So that's incredible. And congratulations, because that growth is insane. So kudos to you.
Well, thank you. It took a long time. This is one of those, it's a 15-year overnight success story. We've been saying the same thing for 10 years, but it takes a long time. You talked about the education issue. It takes a long time to explain to people and to get them comfortable with something. You tell them once, and then you tell them again 6 months later and a year after that. And it takes a while for people to realize, because again, there's so much overselling, so much just selling the latest fad. And it's never the way we approach the business. It was always about solutions, always trying to think about, what if I'm sitting on your side of the table? How do I responsibly sit down with a client and be able to say to them, I found something that's going to make your financial life better. It's going to help you to meet your financial goals. It's been a great pleasure over the past number of years to be able to talk to investors, allocators, RIAs, advisors, and try to understand, what are your clients' big concerns and how do you help them? And if there's something that we can do to help them in that, then obviously, that's what we tried to build a business around.
That's fantastic. So What I've heard is that you had a very long career, in the hedge fund world, but there were also a lot of things that you didn't love about that, and that you felt like you could do it not better necessarily, but you could achieve better results to not cost as much to the investor. When you were kind of the contrarian to what was going on at the time, I think you said you founded it in 2012,
Right.
your company. What made you know that you were onto something or that you really were going to be successful at the time?
So I've been thinking about this issue for a long time, which is basically, I mean, it goes back about 20 years that I first started thinking about this, which is when you talk about hedge funds. I mean, what is a hedge fund? A hedge fund is just simply it's a vehicle. Instead of investing in a mutual fund or an ETF that anyone can go buy, they're in partnerships. You have to meet certain accreditation requirements. They can be more illiquid, and so historically, they've been for very wealthy families who there's somebody very smart and they can give them their money, and that investor will do better over time than just investing in stocks and bonds. But it was always sort of a very exclusive club, and then it became an institutional product. So institutional investors would invest in it as well. Most of the time, when you try to get those same people with those same strategies and offer them to the broader universe through what we call democratization, put them into a mutual fund or an ETF, the results in general have been disastrous. And in that, it's often you look back after 5 years and you think like, oh, why did I bother? These things are complicated. It didn't work the way it was supposed to. But I've always felt for the past 20 years that there would be a moment in time where advisors would walk into the office and say, stocks and bonds worked. And they work when there's no inflation. They work when in the 2000s and 2010s, when various market conditions made that a wonderful combination. But you go back to the 1990s, you go back to the 1980s, 1970s, 1960s, it didn't work, right? So we had a playbook that worked for a period of time, but would stop working, and it stopped working this decade. And so, if you remember in 2022, both stocks and bonds plummeted at the same time. So there was nowhere to hide for most portfolios.
Right.
Going back 10 years ago, we thought, well, what kind of a strategy would do well at that moment when investors need it the most? And there are different kinds of strategies, but we were really only focused on one that we thought would really bring what we call the most diversification bang for the buck. Something where it can go up 20% when everything else is going down and still make healthy returns for you during the rest of the time. So I will tell you, as an entrepreneur doing this stuff, no one writes a business plan and 10 years later has to go exactly. But the whole point of it is you go out and you learn, you talk to people and you see and you try to understand, how can we do what can we do to make your lives better? And sometimes there are things I used to talk to people and they'd say like, can you give me a product that does 1% a month and never goes down? Like, well, no, I can't, and in liquidity and fees, et cetera. I can't do that. But the things we have been able to figure out, the most sophisticated allocators at some of the biggest, domestic institutions, in terms of value for money, the benefit that we get and the ability to invest in it. What these guys are doing is very, very special.
So when you first started your company and you guys were, I guess, kind of testing the waters, how was it received by investors? Were they speculative? Was it really well received?
I see a million different shapes, sizes, colors. When we first started talking to, we're talking about to institutional investors, the ones who are already invested in these strategies. And we came along and said, we have something that is simpler,
Mhm.
cheaper, and puts up better numbers. And they hated it. It's not their money. They have joined one of these big pension plans or one of these consulting firms. They have a lot of power, and you get a multi-centimillionaire hedge fund manager who will fly in to see them because they're an important allocator. It's not a very taxing job. It's not, you have, good benefits and vacations and everything else. You kind of like what you do. So when somebody comes in and says, all that stuff you're paying a lot of money for and I can do it more cheaply and efficiently. Honestly, they don't want to hear that. If it's that easy, what am I there for? What's my job? We've had a great deal of successes in the RIA market. And because it's the RIAs, a typical RIA is thinking about how do I make my clients' jobs better? And the independent RIA world has been a great market for us because a lot of them have come from larger banks or wealth management firms where there's a lot of pressure to maximize your fees. expensive products that where everybody makes money. Like, so, my view on hedge funds was that they're incredible businesses. They can be extraordinarily profitable, but often what clients end up getting at the end of the day is not great.
Right.
Well, it can be, but usually it's not. So what we tried to basically do is say, how do we get sort of the benefits of it, but not have all the costs associated with it? Now, you go talk to a typical registered investment advisor who's building portfolios for their clients, and they know they're missing things. And they can see the hedge funds over there across through the velvet ropes, but they can't invest in it because their clients can't meet the accreditation requirements. Their clients aren't willing to tie up their money for a long period of time. They know they need it. But when they were at a big bank, they were often selling the stuff where everybody, again, made money but the clients. So now they're out on their own. And they're like, we're fiduciaries. We've got to do right by our clients. And what does that do? It means you look for ETFs. Right. It's very, very hard for everybody to kind of make money on ETFs. They're very open and transparent. You care about things that are lower cost or more index-like. The other end of the spectrum, you have the portfolios that are too simple, right? Like a 60-40 portfolio, again, worked great for a period of time. People don't talk about it very much anymore because it hasn't worked this decade. But in the 2010s, it's all anybody want to talk about. But a simple Vanguard 60-40 portfolio is too simple. It's become apparent. Like, I tell this great story about, it's December of 2021, and I'm talking to a guy who's running a 60-40 portfolio, and we have an hour-long conversation about how inflation is coming back. It's going to decimate bonds. It's going to decimate all these different things. Ask him, what are you doing with the portfolio? And he said, I have to rebalance. I have to buy bonds because equities had gone up and bonds hadn't. So even if he knew it was a terrible investment idea,
Right.
he had to buy more bonds at the worst possible time. So what RIAs are trying to balance between how do we find good things, but as a fiduciary, that are low cost and that our clients can invest in $10,000 if they need to, or $20 million if they need to. That's the world that I've gone into. And that's where we've gotten a great audience. 10 years ago, I said, how do I help them in their business, and what would I want if I was sitting on their side of the table, and what do I think is a good investment product, not something I could sell? And then 10 years later, we have a business.
Fantastic. Well, earlier you mentioned, you said you want to try to help advisors create a balanced portfolio. And so our last guest we had on was really making the case for institutional private markets, evergreen funds. So especially for a 2026 portfolio. So from your seat, what you all do at DBI, where do you agree with that strategy and where do you push back a little bit?
So I've known the private equity and private credit business for a very, very long time. A lot of the appeal of it is what I would say is a non-economic appeal. A private credit portfolio gives you a great coupon and you can't see the risk because it doesn't go up and down. But going back to my point about everybody getting paid. So the question that I would ask, there are great private credit managers, great private equity managers out there, like truly unbelievably talented people. But as an investor, right, I know if I'm relying on somebody for their advice, I need to know what you get out of it. And if you're my truly independent advisor who doesn't make a penny on it, I will trust your judgment a lot more.
Right.
Than if because I've written about this stuff in the past. You can have people who have advisory businesses where they make some money on it, but the real money that they make is by putting their clients into private equity funds. Now, they still might be good investments, but I'm going to hold their feet to the fire and understand exactly how much is everyone getting paid.
Right.
Because if I'm going to trust you, I need to know that. We don't do that. We've been a client of banks for a long time. By the time they show it to me from the banking channel, I saw it 10 years ago from my friends. It's a real challenge when you're thinking about you as an investor managing your relationship with your advisor. And part of the reason I like generally the independent RIA community has tried to clean out a lot of those conflicts of interest. They actually can serve more reliably and ethically as a fiduciary. It's not all, by the way. The wealth management business is a business that's based on trust. And it's based upon, when somebody goes to hire an advisor, it's usually a referral from somebody else that they know. And sometimes, what happens with the larger banks or the larger organizations is they themselves have such a prestigious reputation that you feel like, look, I made this money selling my business and I'm sitting on all this liquidity. And, you've kind of seen them across the way, like, oh, that's like a JP Morgan or a Morgan Stanley or something. And feel like when you can give them money and they'll take you on as a client, you've arrived. And it's true. Like, you've unbelievably talented people and great organizations and tremendous resources. Just the thing you have to remember, though, is that they're also in business.
Right.
And if you are going to hire somebody to work on your house and they're going to hire subcontractors and they're going to, it's we know that you need to know, like, if the architect is telling you that you should put an extra wing on your house, and then you find out the architect has economic incentive for doing that, as beautiful as that wing looks, you should take a step back and think about whether this is the right architect for you.
We're talking about how you wrote before. You have, some writings and things. A marketing assistant, she wrote this specific question, and I'm very intrigued because she said that you spoke specifically about single manager risk,
Uh-huh.
and it's widely underpriced. And then what my question to you is, what does that mean practically for an RIA who's really building their alternative assets?
Most alternative assets are sold, not bought. And by that, I mean a typical firm will have a suite of products, of which at any given point in time, some are doing well and some are not doing well. And maybe most are not doing well and one is doing well. They will also have a large distribution team scattered around the country. And the distribution person walks in the morning and says, what can I sell today? And they're economically motivated to do that because if they sell something today, they will get paid basically today. So the architecture of the asset management industry, particularly when you're dealing with the large firms, but you can look at the ETF firms that are just, kicking out a new product every day, is if we shoot enough stuff at the wall, something will stick. If we have a big distribution team, there's always something positive to talk about. What's happened over time is that you as an RIA, you decide, I want to look at this space. You might Google, like, who's in that space and who's writing papers. And you've had incomings from people talking about, 3 funds in that space. They're the funds that have been doing well. What people do is the way the marketing works is because, look, there's a lot of luck and a lot of randomness in investing. And if you flipped heads 3 times in a row, they will come in and tell you we've got a one-sided coin. There are no tails on this coin. And so what happened in the introduction of kind of these alternative products in the RIA and wealth management space over the past 15 years is that the RIA decides to look at a space, but they only see a tiny subset of it.
Right.
They see the funds that are the biggest, with the biggest infrastructure, with just happen to have good numbers. And so how do you protect against that? Okay, so one is you should be very, very, very skeptical of track records. When somebody is telling you a fund, you need to look at the whole track record, see how long they've been doing it, and then just understand that their motivation is to try to convince you that this is going to keep working for the next 3 or 5 years. Number 2, you need to do a little bit of work to look at the whole space. Because if the space has done 2 and somebody's showing up to someone who's done 8, probably you should run screaming from that. Because probably they've been flipping heads. They've been taking risks that we don't understand. Those are often the ones that do the worst. And the last thing you should do, and so a great question to ask anyone who comes to talk about the fund is, show me all your funds. Okay, show me every fund you've done in this broad category. Show me how they've done. If we were talking 3 years ago, what fund were you pitching 3 years ago? And 3 years before that, what fund are you pitching? And all it does is it puts them back on their heels, which is where they should be, because they're coming and asking you for your client's money.
Right.
It's their burden to prove it. So, but the dynamic of what happened with a lot of advisors is that when they think they found somebody who's the best in class, I could use the example of the Lionel Messi or the LeBron James, because often the advisors want to impress their clients, that they found LeBron James, they found Lionel Messi, and they oversell it because they get convinced that this track record is going to continue. They want to show their clients, look, we found this diamond in the rough. And don't worry, it's an expensive fund. It's tax inefficient. It's all these other things, but it's great. Even after all of that stuff, it's a great, great fund. And what happens is a lot of the clients at the end of the day, they come back, 3 months later and like, how's LeBron doing? 3 months after that, how's Messi doing? Because these funds often crash back down, it makes the advisor look bad.
Right.
Your value proposition as an advisor is no, I'm going to search far and wide to find the best things for you that make the most sense. And now you've impressed me as your client by telling me you found something new and interesting. And if 6 months later it's not working, it's not just how did Messi break his leg? It's why did you overpay for Messi at the peak of his career? Again, I'm just I don't know think about soccer, but it's just but so what ends up happening is the last thing an RAA wants to do is spend a quarterly meeting or an annual meeting with a client, spending 30% of your time talking about 3% or 5% of the portfolio.
Right.
They want to be spending the very, very best meetings between an advisor and their client. Thank you. I'm happy with the broad results of my portfolio. I'm thinking about buying a second home. What do you think? I think I want to dial up my life insurance. Should we be doing something with a second home? Like you want to be there to help clients with the holistic things that really matter to them. You don't want to be trying to explain what happened to some stupid equity long short fund that's going through a bad drawdown.
That makes sense. And so when you're advising or, helping people, advisors, clients, thinking about alternative assets and how they either perform well or don't. You have a framework that I read. It's what can't be replicated. I was wondering, what asset classes do you believe genuinely are different from public markets that will justify illiquidity for some of these assets that are in the alternative space?
If you could have invested in SpaceX 10 years ago, right? I mean, of course, right? But you're not going to get that through public markets. So you've got to find another way of getting exposure to that. Usually that's through things that are hard to get access to. And usually if you just kind of randomly pick funds, you're going to, pick wrong more often than right. My focus is really on what can you put in your portfolio today that makes your portfolio better. And there are very, very few things that I would call hedge fund strategies that actually make your client's life better. They may sound good. You may look smart briefly when you introduce it to a client portfolio, but I'm talking about the average of what they call these like kind of hedge fund strategies in mutual fund wrappers for the past 15 years has done between 2 and 3% per annum with like 200 basis points of fees. So imagine you took money from the S&P 500, which has earned 14% per annum, and put it into that garbage, expensive garbage, okay? Or, you took money from bonds, and again, bonds 2022 changed everything about the bond market because of the drawdown we had. But for most of the period of time leading up to that, you're taking something that was rock solid in terms of stability and, low cost, and you understand what it is, and you put into something complicated that does even worse than that. The strategy that we focused on is a very, very simple strategy and concept. As an advisor, what is the value proposition of that, and why is that? Why does everyone do that? And there are two answers to it. The first answer is that unless you have an iron spine, if you have an iron spine, put all your money into equities and do nothing else. But you've got to be able to weather 40 or 50% drawdowns and not freak out. So this is why, Warren Buffett historically said, if I didn't have Berkshire Hathaway, I'd put 5% in cash, 95% in the S&P 500 and not look at it again. But Warren Buffett is, a different species than the rest of us. So you diversify across asset classes because diversification, they call it the one true free lunch in finance, which means basically, 1 plus 1 plus 1 plus 1 plus 1 equals a bit more than the sum of that from a risk-adjusted perspective. And that's principle number one. Principle number two is we're long-term investors and we're the steady hand at the wheel. All of these models are built on the idea of something called strategic asset allocation, where somebody says, I think the S&P 500 is going to do 8% per annum over the next 10 years. I think international stocks are going to do 9. I think emerging markets is going to do what, but bonds are going to do this. Multifamily real estate is going to do that. You have your assumptions for every asset class, and then you try to build a portfolio from all these different things that's going to give your client the most amount of return for the amount of risk that they can individually take or related. And the principle of it is we don't panic. Okay, that the markets are noisy, that, the market's gonna freak out every now and then by tweets or central bank policy or geopolitical events or something. But looking at it a long enough horizon, this is the right thing to do. So with that, I say that they are slow by design. I used a very extreme example of that with the 60/40 portfolios. And so the rebalancing of 60/40 portfolios worked for 20 years. It worked terribly in 2021. Yeah.
Yes.
So that's the issue with these portfolios is sometimes the world is going to change and it's going to take you a few years before you start adjusting your assumptions on these portfolios. So what works well then?
Right.
And there is one very, I don't know, sort of esoteric, weird, complicated hedge fund strategy that used to be called CTAs, or now it's called managed futures. Some really academic people call it trend following. It's basically a tactical strategy. While everybody else is moving slowly, tries to be early and right about the big things in the market. Is in September 2022, this group of guys who do this for a living started betting that inflation was going to come back by essentially betting that treasuries would go down. They were soon betting that the dollar would be strong against things like the yen. Again, these are not things that a normal investor would walk in and say, like, how am I doing relative to the yen today?
Right.
But if somebody else is doing that, can bring that to your portfolio. These are guys who were buying gold at 2000 or 2200 before, when everyone had left it for dead, right? It didn't even make money. Inflation comes roaring back. People have been waiting gold bugs have been waiting 10 years for inflation to come back in 2022 when it didn't budge, right? And then after everyone's given up on it, then it starts to move. Crude oil in January of this year, we see these guys buying crude oil. So that, just as an idea, is so valuable, right? Because what I do works. This stable, consistent, slow by design, diversified portfolio is 90% of the time is going to do exactly what it's doing. 80% of the time it's, but what about the other 10 or 20%? What can I do that's going to help me in particular at that time? So the strategy that we have in 2022, remember, okay, so inflation hits, stocks go down. Okay, but every kind of stock goes down. US stocks go down, international stocks go down, emerging markets go down, bonds go down. Like investment grade, high yield, tips, every single bond portfolio went down. Real estate went down. Like it hit every single asset class with the exception of two. One was commodities. So which was really oil that year because that's when the Ukraine war started. And then also this strategy goes up 20%. The strategy, to me, I've always viewed it as like there are these times when it just feels like diversification is not working. And you're sitting across from clients who are panicking because, we talked about those investors who work at pension plans and consulting firms. It doesn't affect them, right? It doesn't affect their lives. So the payouts to the beneficiaries drop 20% over some period of time. But if you've got 500, high net worth investors or mass affluent investors, and the market goes down 20%, if it goes down another 20%, it's changing their lives. And so understandably, this diversified portfolio that's supposed to work in all market conditions, when it's not working, they're panicked. So I call the strategy a beacon of green in a sea of red, because it tends to do the best when everything else in your portfolio is down. And so the advisors who were invested with us back in 2022 was a breakout year for us. We have this big ETF. It's actually by far the largest ETF in the world that actually does this kind of a diversifying strategy. But investors who have it, they said, they're in October of that year and their clients are panicking because nothing's working. All those things you normally think about providing diversification, but nothing's working except this one thing. And they said psychologically it was so important sitting across from clients because they could say, look, something's working. And I found this for you before the storm hit.
Right.
And I think that's where the rubber hits the road in the advisory business and I think that's where some of the most interesting work is going on in terms of the psychology of helping clients around managing, I've often called money like bottled anxiety. I mean, I know people who are staggeringly wealthy who are almost just as anxious about their net worth. Just they've got like 3 more digits behind it than they were 20 years ago. And so there's something about money that's very, very complicated for people. And so, but that's also where, where diversification, something that works, can come fit into it. But I started off by saying it's this complicated strategy, and that's where it's I think part of our expertise and our breakthrough success, in a sense, has been being able to talk about it. It doesn't matter how the sausage is made. What matters is the output. What matters is what it does and how it helps you. And I think that's a message that I like delivering that falls flat when you're talking to somebody who's not close to the money and its impact on people's lives, which is when you get into the institutional world.
That makes sense. I mean, one thing that you touched on that I'd like to even to kind of dig in a little bit more on is you were talking about, people, the anxiety around what's going on, and investor sentiment, whether we like it or not, really drives the success and the ebb and flow of what we see, even if it absolutely makes no sense. There's like a lot of times what you see is like these markets shift all based off of people's feelings. And it's like to me it's astounding when I when I first started investing and I was watching things happen, I was watching how quickly it would shift based off of media and the news and like just like you see Trump will put something on, it's like ding, 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 and then there's everything changes and I'm just like, how does one Twitter like change what we do for like how we invest our money? And it's so that is first that was astounding to me. But you're talking about a time right now where probably since COVID has been one of the most uncertain times we have economically, where we're looking at what will 2026 bring, because we've all been expecting this this like giant shadow that happened from COVID has just still not gone away. It's just kind of lingering around and no one knows, will it just dissipate or will it come crashing down? So I kind of like to know what your thoughts are.
I think this is, like really serious people who think about this think we have more uncertainty today than in any time in our professional careers. But to me, what's astonishing is that nothing has broken, really broken.
Right.
So, so whether you love or hate Trump or somewhere in the middle, he is pushing the boundaries of the system wherever he can. The initiation of a trade war that is the worst in 90 years or something, or the biggest in 90 years. There were people, predicting that we would be in basically a nuclear economic winter, basically, because of this. Trade would cease. We have a full frontal assault on the independence of the Fed, which is kind of one of the cornerstones of of keeping inflation down. We have geopolitical events. But what's incredible about it is that nothing has sort of spiraled out of control. Usually that's the case because there are a lot of people who have a lot of power who don't want things to spiral out of control. And as you see with the tweets, there's like push, 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 push. The markets start to truly freak out and then back, 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 and then push, 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 and I think for any investor today, one of the challenges is how do you forecast out 5 years?
I mean, these days, 5 months.
5 months. But again, going back to this idea of these models, right? So remember, like these, in a sense, part of the strength of these models is they've not gotten head faked by all these tweets. There have been things about like, is the value of the dollar going to collapse?
Right.
We have an unsustainable level of debt that no one seems to care anymore about addressing. At the same time that interest payments on the debt are going up, which is kind of creating a self-fulfilling prophecy. You can look to a place like the UK where, bond markets are really losing patience with this. So there's this sense right now that there are kind of cracks spreading in the system.
Right.
And you don't really know when something's going to break. And it's remarkable that it sort of hasn't.
Yeah.
But at the end, but look at AI, right? I mean, the other end of the spectrum, you have AI, which is accelerating and is going to have implications on every aspect of our personal and professional lives in ways that we cannot even begin to understand today. So I think as an investor, I think this is why you must diversify. Last year, part of the reason European or international stocks outperformed U.S. stocks was because investing in the U.S. had always been a no-brainer for about 15 years. We've clearly got the best companies in the world. We had the best rule of law. We had best capital markets. And international investors, because of the concern about the geopolitical changes that are happening in the U.S., you started people at the margin sort of pulling things back. As a result, for a while, European stocks were outperforming. I think when the war hit, ironically, I think people reversed it because they're like, if oil stays up, Europe's far more screwed, or Asia's far more screwed than we are. I think when you see all these changes out there, the reality is no one has a crystal ball as to what's going to happen. What we're seeing is actually the spectrum of outcomes is so wide, which is why, a tweet that points us in one direction versus another direction is causing markets to move. I mean, major markets are moving almost like meme stocks. Crude oil is up 90% this year. right? Gold is doubled. These are not what most people think about, but over the past year, most equity markets are up 40 to 50% after people thought that they were going straight south after Liberation Day. So it's a very, very, very challenging environment. And that's why, when you bring up things like private assets and tying up liquidity,
Mhm.
just think about what that means, right? You're making a bet that you don't need that money back for 5 years or 7 years or 10 years. Okay, if that's 5% of your portfolio, I get it. Are you comfortable having 30% of your portfolio in something where, remember, we went, and after the GFC, you could not get your money back. There were municipal bond strategies during the GFC where you could not get your money back for years. And so this is where I think the theory of asset management and the impact on people in the real clients of registered investment advisors, I think people just need to be very careful about how they're thinking about things today. They need to think about risks you wouldn't normally think about. Here's something I've talked about recently. I hope, right, that the situation in the Middle East is resolved in some sort of a favorable fashion. But, we are dealing with an adversary who has spent decades with huge resources thinking about soft targets. Okay. I was in New York on 9/11, right? We have AI where people at one point were worried about creating bioweapons with AI. We have had this kind of quiet Cold War of sleeper cells and things going on all in the background. We are dealing with an adversary who thinks in life or death kind of religious terms, as opposed to it's going to disrupt my job or my lifestyle, who are in a sense fighting for their lives or protecting not just their lives, but their families and where their kids go to school, etc. Is there a possibility that we're going to wake up one day and 6 commercial airlines have been downed by drones around the country? At Dirty Bomb, which we used to talk about a lot after 9/11 has come back, water supply has been poisoned with a bioweapon. The risks clearly, and the ability, because when I talk to people in the business world about AI, the astonishing thing is they're like, yeah, I could do tons of million things on my own I couldn't do before. And this is why I think it's like the spectrum of outcomes. Like we could see oil at 200, or things could get resolved wonderfully. And if things get resolved wonderfully, and then Trump will be Disraeli, and and he'll be the greatest statesman who ever lived. But there is always this potential that things really spiral out of control. So I would just tell people, look, don't go sit in cash. Don't sit out things. You have to find a way to make money. You can't get onto every plane ride and worry about what seat has the highest probability of surviving a plane crash. You have to kind of assume you're not going to have a plane crash. But you could do a little bit of planning. You can bring some insurance for your portfolio, for your life, in certain ways. And it's probably a good idea to do some of that planning today.
I agree. And one thing that I think is really important for people to understand is when you talk about the diversification of your portfolio is allocation. You talked about the 60/40 model. What is it right now that your company really is putting it as like the allocation for our portfolio? What do you guys think is best right now?
So we don't look at the whole portfolio. There are people who do that.
Okay.
Well, I think what's happened though is that people have a very hard time changing their mind, and a lot of the wealth management business was built on the principle of 60/40 or a variant of it. Over the past 10 years, the 40 has been a mistake. It's earned actually less than cash over that period of time and just hasn't provided diversification. One of the things I would encourage people to do when they're thinking about diversification is you have to have some tools to help you to understand whether something's really providing. You have to define what you mean by diversification. Diversification generally is not going from growth stocks necessarily to, high dividend paying stocks or something. You'll get some diversification, but not a lot.
Mhm.
High growth stocks, Meta, whatever, the Mag 7 collapse, trust me, your dividend stocks are going down as well. So you want to have tools, and AI is phenomenal at this, right? You can ask AI, you can plug in, you can say, here's my portfolio. I'm concerned about a repeat of 2022. Do you have any ideas? What worked well in a year like 2022? I really want something that marched to the beat of a different drum. And LLM will say, okay, what you really mean then by it is, statistical diversification. And you don't even have to know what that means, but they'll help you to understand it. So as you think about this, you think about kind of like what actually gives me something that's different and valuable as opposed to something that just sounds different. I think what AI will do is it's arming people to have those conversations. Your financial advisor gives you, just plug in your client statement into ChatGPT or Claude and ask them, what do you think? What do you think are the risks of my portfolio? And so, in a sense, AI, this sort of great thing about social media is often viewed as this, it increased polarization in a way. It concentrated wealth in a certain number of people. And I think it's probably damaging to large segments of the population for psychological and other reasons. But AI, in a sense, can be your equalizer. You can ask AI, what do you think are the 3 questions I should be asking about my portfolio? When I give you my portfolio, what are the 3 scenarios you think I should be worried about in this? And if you keep prompting it and you treat it as somebody as like, first of all, you have to assume that they're going to make a lot of mistakes, right? So don't take everything for given, but it's almost like having a team of researchers at your beck and call. And what I love about it is that when I deal with human beings, there's this reluctance to make a mistake, right? So I ask a question and we start doing some work on something. It takes a day or two to get something back. There's a lot of thought that goes into it. AI just slams it back at me. And it can be unbelievable or it can be wrong, but it gives you something to respond to almost in real time. And so, so I think as you think about, protecting your portfolio today, and I think you think about what are the right allocations. I mean, what we do is going to be a small part of your portfolio. I think a 5% allocation to what we do makes every single portfolio that I've seen better. And by better, I mean, is it going to do better at weathering a year like 2022? 10 years from now, are you going to have made more money with the same amount of risk? Or have you been able to protect yourself more by generating the same returns? We've tried very, very hard to make that possible. But it shouldn't be 20% of what you do.
Right.
I can make a statistical argument that it should be 20% of what you do, but you have a lot of different options of things to invest in, and the reality is what we do is complicated. It's a lot harder to explain than stocks and bonds or real estate or things that people feel is much more tangible, understandable. So in that context, I just have to, I always think it's important to have it there. Zero is the wrong number, but just have enough so that when you hit a year like 2022, you're thrilled you have it. A year like last year, we're up 14%. You're thrilled you have it. This year, we're up 12%. When everything is kind of even rocky, you're thrilled you have it. But it doesn't become this focal point in your portfolio because it's just too complicated for most retail investors.
So I'll ask you this final question. If there was one question that, most people, new clients or people come in to work with you have that I would say is either a question that would help them understand, because you mentioned how it's complicated. It's kind of hard to break it down. So if there was one question you were answering that you think will kind of simplify things for people, what would it be?
I think the question is, does it make my life better? And how do you define that? I have very, very technical conversations with people about what we do. This morning, I was on the phone with a guy with a PhD from Europe, and we are drilling deep down into the weeds. For the end client, right, we have to be very, very clear what the goal is. And the goal is to very simply grow their money and help them sleep at night to the extent possible, help them meet their financial objectives. The tools that you have to do that should be thought of and defined in terms of how they help the advisor to help their clients achieve their financial goals. And I think too much of this business is about trying to dress up very complicated, very expensive things in a way that they try to impress people with complexity. One of the things that drives people insane sometimes in the hedge fund industry about what we do is they'll say, I invest in 500 things. And I'm like, yeah, and we double your returns with 10. It's simplicity, predictability, repeatable processes that work over time through market cycles. That's the foundation of a reliable investment. And thinking about how is this going to help me and why? Because anything you invest in, it's elective. You don't have to. You can put all your money in cash and leave it in the mattress. It's not a good idea from a long-term financial perspective, but it's your money. You can decide what you do with it. And I think a lot of the business is built around, I'm offering products. How do I justify the most fees that I can get out of the product? Well, complexity makes it sound like the more I'm spinning plates, the more I'm doing all these other things, it sounds like, wow, that's, I'm going to pay you a lot of money for that. Just as an investor, to me, some of the best, most obvious investment ideas have also been really simple and straightforward. And I think it was Charlie Munger who was Warren Buffett's, great partner for decades and decades until he tragically passed away, well, tragically at 101. He used to always talk about, if you can't boil it down to a very simple argument as to why this should be a great opportunity, it's not even worse. You shouldn't do it. I see a wave of people thinking more and more like that. It started with Vanguard. It started with 60/40 portfolios, which were a huge benefit to investors because they were doing it very, very cheaply. The initial evolution of the business was to add a lot of complexity to 60/40 portfolios, which didn't work very well. And now I see people basically saying, all right, let's take that same ethos, lower fees with the right kinds of products and help. Tax efficiency helps. Diversification helps. And let's put that together in a package, starting from the place like, we want to make our clients' lives better. That's the most important thing.
Absolutely. Well, I have taken an abundance of your time, but I enjoyed every single second of it. So, Andrew, thank you so much for joining me today on Wealth Unfiltered.
Thank you. It's such a pleasure to be here. I'm always grateful to have an opportunity to talk to people about what we do in the world in general.
Do you want to let everyone know how they can reach you?
Sure. So please reach out to me. So you can reach out to me, first of all, on LinkedIn. You'll see a picture of me and my dog, my late dog, who unfortunately died almost a year ago, speaking at an ETF conference. But it's Andrew Beer, BER. My firm is DBI. I'm very accessible. So if you have any questions about what we do, just hit me on LinkedIn or come in through our website and you'll get a call from me in 10 minutes.
Fantastic. Thank you so much. Andrew's framework came down to one thing: knowing what you're buying. So the next natural question is, how do you do diligence at scale to ensure your portfolio is curated intelligently? Next week, I sit down with the firm RAs call before they write the check. I have the co-CEO of Factoright, Jake Heidkamp. You're not going to want to miss the episode.